evening, all the joinees. Thank you so much for joining in. This is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. Before I really begin, I just wanted to make sure if my screen is clearly visible and my audio is clearly audible to all of you guys. If someone of you could confirm, it will be useful. Thank you so much. So now, meanwhile, others join, what I will really do is introduce the topic for today. Today, we will be covering using NGEN Fund Scores. How do you build model portfolios? So we will understand first what is the meaning of NGEN Fund Scores, what do the rankings really mean. Post that, we will build a portfolio using just NGEN Fund Scores. Of course, there are multiple parameters to actually use when you're building model portfolios. In the previous sessions, we have discussed rolling returns analysis, rolling returns distributions, Sharpe ratio as a parameter to use while building model portfolios. But in this session, we are going to use how do you effectively do that using NGEN Fund Scores. Next, we will understand the improve function, and we will see how you can use that to optimize the portfolio allocation that you have just designed, right? So typically it will be an equally allocated portfolio, and then we will understand what all are the three different methodologies. So let's say if you're building the portfolio for an aggressive investor versus to that maybe for a moderate investor, or for that matter a conservative investor, how will the allocations really change, and what is the logic on which this improve function really works. That's the second part of the webinar. Next, we will move on to understanding how you can compare the performance of the portfolios side by side for comparisons. So let's say you've loaded in a prospective client's portfolio on one side, and on the other, you will load in your model portfolio, and you will show how the two match up. And you can ultimately generate reports out of that. So we will have a look at that. Lastly, we will see how we can generate actionable proposals from this in forms of PDF reports. Finally, we'll move on to the Q&A session, wherein you can get your questions answered by either typing in the chat box or directly unmuting yourself to speak. So let us now begin. So for the purpose of the webinar, first, of course, we'll be having a look at what do these NGEN Fund Scores really mean. So for that, I have loaded in a fund in a new tab. So this is a Bandhan Core Equity Fund. This is from the large and mid cap category. Now, you will see there's a black brick that appears beside the name of the fund. That typically gives you an idea, okay, what is the fund score that is assigned to that particular fund. The moment you click on this fund score, a window opens up, which reflects three parameters. Number one is the consolidated NGEN FS, that's called fund score, which will be visible at multiple places on the platform. Next is the risk score, and the third one is the return score. So let's understand everything one by one. So NGEN Fund Score, that's 7.12. Now to calculate this, we consider three parameters, two of which are quantitative, one of which is qualitative. So let's understand the quantitative parameters first. So we consider a 10% weightage given to the AUM of respective funds, and that is clearly mentioned here. So we use a combination of AUM, and the second quantitative parameter that we use are short, medium, and long-term risk adjusted returns. That's returns and volatility, right? So when we say risk adjusted returns, what we are really using here is the Sharpe ratios. Now, what do we mean by short, medium, and long? So by short, we mean 1 year time frame. Medium, we mean 3 year as a time frame, and long, we mean 5 year as a time frame, right? So we give equal allocations out of the 90% balance. 30, 30, and 30 go to short, medium, and long-term risk-adjusted returns, which is Sharpe ratios. Once this allocation is done on the basis of quantitative parameters, qualitative parameter is taken into consideration to arrive at the fund score. What is that qualitative parameter? So that is typically the age of the funds. So for an example, if we have a very, very young fund in the list, for an example, let's simply load in a White Oak large and mid cap fund, right? In this list of large and mid cap funds that has been given the lowest score, right? 0.02. Now, why is that so? One among the other reasons is, major reason is the launch date. So this is a very, very young fund, just 3 months since it actually launched, right? So there is very limited data to actually fill into the buckets when we calculate this fund score, right? Because short, medium, and long, we do not have data to put in, right? So if a fund is a very, very young fund, typically it has not completed even 1 year since its existence, it will be given a disadvantage over funds that have actually spent fair amount of time in the markets, right? So typically you will see younger funds getting lower fund scores as compared to the funds that have already spent at least a 5 years period in the markets, right? As the period increases, so for an example, if you see a 10-year-old fund versus, let's say, a fund which has been around, let's say, for a period of 20-25 years, there'll be no disadvantage that will be given to the 10-year-old fund. That's because we have data to fill in those buckets, right? Short, medium, and long term. So only those funds who have not even completed 1 year um, will be given those disadvantage over funds that have actually tried and tested over a period of time. Now, this was the calculation methodology for the NGEN Fund Scores, which is consolidated score, risk-adjusted returns. On the other hand, you see the other two scores, which is risk score and return score. Now, to calculate risk score, the only parameter that is considered is the volatility, which is measured by the standard deviation of all the funds. So in this case, Bandhan Core Equity Fund, for let's say, for an example, for the last 5 years, it has a volatility of 18%, right? So this one parameter will be considered across all the funds from its category to arrive at this risk score. The risk score of 4.523 typically means that the volatility protection, right, is not very, very good for this particular fund. If a risk score would have been higher, that means the volatility protection, or for that matter, that particular fund is less volatile, right? So higher the fund score, the better it is. And that is applicable for all these three ratios. So even if we consider return score, right? If we consider a return score of a fund with a return score of, let's say, a 6 versus a fund with a return score of, let's say, a 7, you can typically say a fund scored 7, the mutual fund that has a return score of a 7 is definitely performing better than the fund score of 6, right? So higher the fund score it is, the better it is. That's the logic for even NGEN Fund Score, risk score, and return score as well. Now, an important point to note here is that these fund scores are comparable only within the category of these funds. So when we open in Bandhan Core Equity Fund and we load in this entire black brick, which opens up the NGEN Fund Scores, it says Bandhan Core Equity Fund has been given a scoring of 7.12 versus all of the funds from the large and mid cap category, right? So please note here, the comparisons happen within category. So you can say that, okay, Axis Growth Opportunities Fund is a better performing large and mid cap fund as compared to a Bandhan Core Equity Fund. However, these fund scores will not be comparable across categories, right? So inter-category comparison doesn't happen. You cannot compare a fund score of, let's say, a Parag Parikh Flexi Cap, which is a Flexi Cap fund, with a large and mid cap fund, right? Because those are two separate categories altogether. These fund scores are always comparable within the category. Once the understanding of the fund scores is clear, let's understand how what is the frequency with which this get updated. So you will see when you open this, there's a last 12-month data point that will be visible. So these fund scores, the consolidated fund score, get updated every month. So as of now, you're seeing this fund score for 29th of February 2024. That's February fund score. As we close March, you will be able to see the March fund scores given to all the funds, right? So this is what fund scores really mean, and this is what this is the logic that we have used to arrive at these fund scores. Now, once this fund score logic is clear, let's go back to NGEN Markets main platform, wherein we will touch upon the topic that we have decided to cover today, which is building model portfolios using just one parameter, which is fund scores. Right now, the only input that will be required from your side is the categories that you would wish to cover um, to include in your model portfolio. So for an example, I'm just going to take in a 5 to 6 categories, typically 4 or 5 from equity, 1 from hybrid. You could take as many categories as you would like. Just specify them using this filter categories tab. So what I've done is I've just opened in this filter categories tab. It shows up 4 buckets: equity, debt, hybrid, and others. Now I'm just going to choose in the subcategories. So let's say I want to include funds from flexi cap as a category, focused as a category, let's say large and mid cap as a category, multi cap, value funds, and maybe balanced advantage funds back, right? So these are the 6 categories that I'm going to cover today. You could include as many categories as you would like, as I've already mentioned, right? Once you've mentioned your categories, you click on close. The moment you do that, all the funds from these particular categories will get listed over here. Now you would rather like to narrow down your search, or for that matter, the funds that to be included in your model portfolio on the basis of, let's say, some non-negotiable filter parameters. Now, what do I mean by non-negotiable filter parameters? So whenever I'm building a model portfolio, I do not want funds which are very, very young. Therefore, I go ahead and put in these filters to say that, okay, give me only those funds who are at least 5 years or older. So I put minimum age as 5 and I click on apply. Now, in this list that I will have only those funds from these 6 categories that have been around for at least a period of 5 years. Next, I could go ahead and put in some basic minimum AUM as a parameter. So let's say I want only those funds having a minimum AUM of 2000 crore and above. So I put in minimum AUM and I click on apply. So these are the funds that actually meet both of my filter parameters. Now, what I will do is, on the basis of NGEN Fund Scores, that is a column that is visible right here, I will pick the best fund from every category with just one rider. Let's say I see, okay, ICICI Pru Value Discovery Fund is the best fund in the value category. And then there is a repetition, okay, in, let's say, BAF category as well, I see a ICICI AMC fund only, which is the best performing fund. So just in order to ensure diversification in the portfolio on the basis of AMCs, I do not choose that AMC if that is a repeat AMC. Okay, so that's one subjective call that I'm going to take. Of course, you could go, all out and choose funds which are actually absolutely best in those particular categories, irrespective whether if the AMCs are getting repeated or not, right? So now I'm going to focus on one single category at a time. So in this case, the first category that I have is a value fund category. The best performing fund from the value category is the IPRU Value Discovery Fund. Now, why do I say that? I say that on the basis of the fact that I have sorted this entire list that I have of these funds on the basis of this NGEN Fund Scores, the logic of which we just discussed, right? So I see that, okay, IPRU Value Discovery is the best performing fund from value as a category. I simply click on this add to compare icon that you can see beside IPRU Value Discovery. The moment I click on this, it is going to get added in the compare section right here, right? So you saw IPRU Value Discovery has gotten added in the compare section. Similarly, now I'll go back to the fund section. Now value category is done with. Now I'm going to come to the next category. So next category that I have is a flexi cap funds. The best performing flexi cap fund is a Parak Parik flexi cap fund. And I have not covered PPFAS as a AMC previously, right? So therefore, I'll go ahead and click on this. I'll get that fund in the compare section. Next, let's come on to the third category. Sorry, that's dynamic asset allocation. That's typically BAF as a category. Now, in this case, in this particular category, we see the best performing fund in the BAF as a category is a IPRU Balanced Advantage Fund. But have we covered ICICI as a AMC? Yes, we have. So therefore, I go ahead and check which is the second best performing fund in the BAF as a category, and that happens to be HDFC Balanced Advantage. We haven't covered HDFC as a AMC, and therefore I simply click on add to compare. This will get added in the compare section like this. Okay, let's come to the third category now. Third category is done with. So we've covered value, we've covered flexi cap, we've covered balanced advantage. the fourth category that we have at hand is the large and mid cap fund category. In large and mid cap funds, the best performing large and mid cap fund, as per, of course, NGEN Fund Scores, is a iPro large and mid cap fund. But we have already covered ICICI as a AMC. Let's go and check which is the second best performing large and mid cap fund. Second best performing large and mid cap fund could be located right here. This is the category, and the fund that is there is Access Growth Opportunities. I simply click on add to compare, and this fund gets added in the compare section like this. This is the fourth fund. So we've covered 4 categories now. Let's move on to the next category. Our next category is focused fund as a category. Okay, so in focused fund, the best performing focused fund is a HDFC 30 focused fund, right? And typically, if we check, we have covered HDFC as a AMC. So let's go and locate the next best focused fund. So in focused funds as a category, the first ranked fund is HDFC. Next best fund, ranked fund is iPro focused equity fund. We have covered that as a AMC as well. So let's go ahead and check the next best focused fund. So we have focused fund right here, which is a 361 focused equity fund, right? So this is the third best ranked fund in focused funds as a category. So I click on this. This will get added in the compare section right here. So we have 5 funds now. We have covered 5 categories. The last category that is remaining is the multi-cap fund as a category. And that is what we have chosen here, multi-caps, right? So that is pending. So what we do is I simply scroll down and try to locate the multi-cap category. I see multi-cap category right here. The best performing fund from the multi-cap funds as a subcategory is a Nippon India multi-cap. And we have not covered Nippon AMC until now. So I'll go ahead simply and add this to the compare section. So this is how I have a list of 6 funds from 6 different categories, typically falling into first 4 of every category, right? So we have chosen one among the first 4 best performing funds in every category, right? This is how we've come up with this universe that is appearing in the compare section right here. So these are the 6 funds. Of course, you could add the number of subcategories that you want to include in your model portfolios, and accordingly increase the funds to be included in your model portfolio. For a use case scenario here, I've just considered 6 categories. Okay. Once we have the funds or the universe that we are really catering to now to build our model portfolio, we come to the compare section, right? And we just do one final check before converting this to a portfolio. One final check that is really important to do is position overlap. Now, why is that important? That's because we are building a portfolio out of this, right? So we cannot have funds which typically have very, very similar holdings. That's because otherwise the portfolio diversification matrix will go for a toss, right? So the moment you come to position overlap, you can check what is the overlapping scenario in all the funds that we have chosen to be included as a part of our model portfolio. In this case, the maximum overlap percentage I can see is a 38%. So typically less than 40, right? And that's why it is only dark green. We do not have yellows and pinks and reds anywhere in this overlap matrix. And therefore, we can comfortably say that, okay, this is in that way a not very overlapping portfolio. So we have managed to create a diversified portfolio as far as it comes to the holdings, the underlying stocks of it. So what do I really mean by underlying stocks of it is if you simply click on this particular cell, which is iPro value discovery and access growth opportunities, the overlap between these 2 funds is a 12%. Now, what does that mean? 12% of these 2 funds portfolios are similar, right? Are similar with respect to the underlying stocks that they hold, right? For an example, iPro value discovery fund holds ICICI Bank as a stock to an extent of 7% in its portfolio. On the other hand, Access Growth Opportunities also has ICICI Bank as a stock in its kitty, and that is to an extent of 1.90% to be precise. The lower of the 2 is going to be my overlap percent. If I accumulate all of that up, that comes to a 12% cumulative overlap between every pair of funds. That is what I mean by position overlap. So this fairly looks good. Once this final check is done, all you need to do is you simply convert this to a portfolio by clicking on this tab. The moment I click on this, the entire components that I have in the compare section will get converted into a portfolio, which in this case has been named as compare 50, and this will be located in the portfolio section. Rather, this will get saved in the portfolio section. Let's go to the portfolio section and locate this portfolio. So because this portfolio was created from the compare section, it will get saved from here. This is the compare 50 portfolio, so 425 today. The first thing that I'll do is go ahead and rename this. So I'm going to rename this as my model test portfolio for the month of March. I rename this and I hit enter for this to take effect. So my portfolio name has been renamed. And I'm just going to search for the name. So that's model test portfolio March 2024, and I've loaded this for further analysis. The first thing that appears that is very, very apparent when this portfolio is loaded is that there's an equally allocated portfolio. So look at that. All the components that you have in the portfolios are in this portfolio are equally allocated. 16.67% weightage given to every fund in this particular portfolio. So that's because we saved it from the compare section. So it is always going to get saved as an equally allocated portfolio, right? But now, not all portfolios that you would rather advise to clients are necessarily equally allocated, right? They are generally lopsided on the fund, or for that matter, on that particular category, depending upon the risk appetite of your client. So let's say you're building this portfolio for a slightly conservative client, right, who does not want to take in excessive risk, but wants to invest in these categories that we just discussed. So a flexi cap, a multi, a value, a large and mid cap, right? So we have not taken any aggressive category here, meaning to say we have not covered any small caps, we have not covered any mid caps per se, we've covered large and mid caps as a space, right? So let's say you're building this portfolio for a conservative client, then what should be the optimal allocation that should be made to every component in the portfolio so that it caters to the client's requirement? So for that, an effective way of coming up with the optimal allocation is using this improve functionality that you will see at the top beside the name of the portfolio. So first, let's simply put in a period that we are considering. So we are considering last 3 years as a time period. So I simply take, okay, 3rd of March 2021. So this is the analysis that I'm going to do. And then I simply click on improve. The moment I click on improve, it is going to show up 6 different simulations. The first simulation that you see right here is the original portfolio allocation. So this is not even a simulation. So this is what is the original portfolio returns with the original portfolio allocations. So HDFC Balanced Advantage, iPru, Axis, Nippon, Parag Parikh, and 361 Focused. Each of the fund has been given an equal allocation, and that is what is the case in our model portfolio currently, right? That's the original portfolio. In the original portfolio volatility is almost 11.5%, more than just 11.5%. And with this levels of volatility, the returns, the annual return that the portfolio generates is at 22.45%. Right now, as we just discussed, we are building this for a conservative client. He would like to minimize the volatility to the lowest that's possible. Right. In order to reduce the volatility to the lowest, what you should generally be looking at is this minimum vol model. Right. Minimum volatility is what this means, wherein you can see the volatility of the portfolio has been minimized from 11.62% to 10.81%. And that happens to be the lowest in all the simulations, right? Now, by even reducing the volatility to the lowest, you will see there's a slight jump in the portfolio returns, right? And that's really not bad, right? So if by reducing the volatility by 1%, you're getting a jump in the portfolio returns by almost 30 basis points. That's definitely that's definitely a good thing, right? And to achieve this low volatility or the lowest volatility possible, what should be the allocations that should be given to all the components in the portfolio? That is what is going to be given here below the save button, right? So in this case, because we're minimizing the volatility, it makes sense, or rather it's logical enough that HDFC Balanced Advantage, which is from hybrid as a category, has been given higher allocation, or rather the highest allocation. 40% is allocated to one single fund. which has ultimately reduced the portfolio volatility, right? The lowest of the lot, the allocation has been given to Nippon India Multi-Cap Fund. That's simply because in this time period that we are analyzing, the last 3 years, Nippon India Multi-Cap Fund is a fund that has generated, or rather has the highest volatility among the funds that we are really choosing. So in these 6 funds, Nippon India Multi-Cap Fund in the last 6 years has had the highest volatility, and therefore its allocation in the portfolio is the lowest, which makes sense to in order to reduce the overall portfolio volatility. Right now, if you were typically catering to, let's say, a moderate client or aggressive client, you would have rather gone ahead with the simulations that are mentioned beside that. Right, if you're building this for a aggressive client, then you would have rather gone ahead with a rank returns allocation, wherein minimum allocation is given to HDFC Balanced Advantage, or for that matter, highest in this case, you see, has been given to a Nippon India Multi-Cap, for the simple reason that in the last 3 years, it would have had the best returns. On the other hand, if you're building this for a moderate client, you could go ahead with something from the value models and follow something like a sharp as a strategy. So once you've decided what client you're catering to, or what is the risk appetite of the client that you're catering to, you can simply save the allocations that are suggested. So these are the allocations, and we are building this for a conservative client. So we simply click on save. The moment we click on save, this will be showing up a prompt that, okay, we are going to save this as MTP, that's model test portfolio, March 2024, and it will say default optimized, but I'm just going to rename this as a conservative. I'm going to click on create. So this has gotten saved in the from improve function because we improved this portfolio. So that's from improve, and this is where the portfolio has gotten saved, right? Once we have saved this portfolio, you can simply check by running this that whether the allocations have accordingly changed what was really shown by the model, right? So in this case, HDFC Balanced Advantage, as you can see, has been given the highest allocation, and accordingly for others, right? Once this is through, let's move on to the next part of the webinar where we'll be discussing how do you compare two portfolios side by side and then generate actionable proposals out of that. So for that, the go-to tool will be this compare to portfolios icon that you see right in the portfolios section. You'll click on this. This will take you to this particular screen wherein you will see portfolio 2 and portfolio 1 and portfolio 2. So typically the model portfolio or the portfolio that you want the client to be investing in has to be loaded on the right hand side always. Here, right here, about portfolio 2. So in this case, that portfolio is a model test portfolio, March 2024, conservative. This is the portfolio that we have just optimized, right? Now, on the left-hand side, it could be any particular portfolio, which is your prospect's portfolio. For an example, let's say your prospect has a stocks only, equity stocks only portfolio, and then you're trying to pitch him a mutual fund portfolio, and rather telling him that, look, what is the case when you switch from a stocks only portfolio to a mutual fund portfolio. So for that, I'm just loading in a stocks portfolio that I have already saved. I simply search for the stocks portfolio 2024, and this is the portfolio that I have. I've loaded this. I put in a start date. So let's, we are doing this analysis for the last 3 years. So 1st of March 2021, and I click on go. The moment I do that, this analysis gets run, wherein the green line that you see here, the neon green line, is the model test portfolio line, which is the portfolio that you're trying to suggest to the client. On the other hand, the maroon line that you can see is the client's existing portfolios line, right? And you can clearly see a outperformance by the mutual fund portfolio, which, by the way, has only 6 mutual funds, right? On the other hand, the client's portfolio, existing stocks portfolio, has 12 positions. So typically, we've not just reduced the exposure with respect to number of funds, but also we've generated a outperformance by a mutual fund portfolio. Now, this is, mind you, this is a conservative portfolio. So let's look at the volatility statistics. So the existing stocks portfolio volatility, annual volatility, was a 16%. On the other hand, the mutual fund portfolio volatility is a 10% annual volatility, right? So there's a drop of almost 5.5%, and that is exactly what is written here, right? So there's a drop in volatility, which is a good thing. On the other hand, the cumulative return has jumped up 20%. So your original portfolio had a cumulative return for the last 3 years of a 70%. On the other hand, if the client would have invested in this mutual fund portfolio, his return for the last 3 years would have been a 90%. And that's 20% extra. And that is exactly what we are highlighting. Now let's come on to the risk adjusted return statistic, which is measured by the Sharpe ratio that you can see here. The original portfolio's stocks portfolio Sharpe ratio was a 0.73. Versus to that, the mutual funds portfolio, mutual fund portfolio's Sharpe ratio is a 1.37. That's a good enough jump in the Sharpe ratio as well. Right? So these were the return statistics. Now, if you were to check how did the asset allocation change to achieve this excess return on the alpha that is possible. So for that, you simply come to asset allocation as a tab, wherein you'll be able to see that this existing, so the black line that this actually differentiates one portfolio from the other. So you see this black line over here. Everything on your left hand side will be your stocks portfolio or your prospectives existing portfolio. And on the right hand side, whatever statistics I mentioned will be your model portfolio statistics. So in this case, we can see refineries as a sector was a heavily weighted sector in your existing stocks portfolio, almost 45+% coming in from one particular sector. On the other hand, in our model portfolio, we have tried to make it more balanced with respect to sector exposures. And now in banks, as a sector that happens to be the highest allocated sector, and the weightage is less than 15%. Right, so this is not very concentrated to any particular sector, as opposed to your stocks portfolio. So this is something that you can highlight. Once this is done, then you can come to the exposure part of it, which typically helps you in understanding what is the large, mid, and small cap split of your existing versus of your model. So in this case, as we discussed, refineries, of course, was 46, and now it's banks. And now coming on to market cap. So market cap, large cap is 83%. In the model portfolio, that is, of course, reduced to 52%. By others, we have added some debt. So we've added some balanced advantage funds, right? So debt part of it has been added. Mid cap and small cap have accordingly, specifically small cap has accordingly gotten reduced. So this was the exposure analysis. Next, let's come on to the rolling returns analysis. Now, the use of rolling returns analysis while doing a portfolio analysis is it shows you the consistency of the portfolio in generating return. So in this case, what we are having a look at is 260-day time period. That's 260-day rolling return analysis on stocks portfolio versus to that of a mutual fund portfolio. So you see the lowest 1 year return, 260 is equivalent to 1 year everywhere on the platform. So therefore, I'll be referring to 260 days henceforth as 1 year, right? So the lowest 1 year return from the stocks portfolio has been a negative 8.05%. On the other hand, if you compare that with a mutual fund portfolio, the lowest 1 year return, 1 year rolling return, was still a positive 1%, 1.5%, right? So that's definitely a good thing. On the other hand, if you then have a look at the recovery or the resilience of the two portfolios when they are in volatile times, because what happens is how much ever curated you make the portfolio, it is never going to be immune to losses, right? So you need to check when the markets, or for that matter, when the portfolio falls, how quickly does it bounce back? And that is important typically to highlight when you're building this for a conservative investor. He does not want to stay into loss periods or negative periods for a longer time, right? And that's why you should highlight the drawdowns analysis. So in this case, the portfolio that I have on the left hand side has experienced its worst loss of a magnitude of 18%. Negative 18% is the magnitude of that loss. And that loss actually, the loss period was pretty long, almost 300 days, 299 working days. Only after 299 working days did this loss of 18% get recovered completely. right? So it is typically laggard in recovering from the loss. On the other hand, this portfolio that I have on my right hand side recovers its worst loss, which was of a magnitude of 12%, 12.5 to be precise, in the next 38 working days, right? So this could be a good talking point to highlight. Once all of this analysis is done, then you would like to present this entire analysis in the form of reports to your clients. Now, how will you do that? So for that, we have given you an option of create PDF. You click on this, and there are two tabs that open up. So in this case, there's one that's called a standard PDF. You click on that, a percentage based allocation will get created to both the portfolios. So in this case, let me show this. Right. So I've loaded in the PDF report. And a highlight of all of our exports is that they're going to be co-branded, right? So you'll have your own company name and logo appearing here. We've done this analysis, so I'm not going to repeat that. That is exactly what gets exported into the PDF. But what is the game changer is the last page of this report, right? Wherein this can act like a action plan for your client. Of course, this is into percentage terms, and that's the reason it might be a little challenging for the client to interpret or understand. And that is precisely the reason we have given you in to generate this report option to generate this report in amount terms. If you want to generate this in amount terms, what you need to simply do is click on create PDF again and put in the AUM of the client that he has invested in his existing portfolio, right? So let's say the existing portfolio in this case is a stocks portfolio, and the client has invested 50 lakh rupees in his stocks portfolio. You put in 50 lakh rupees here, and then you click on go. The moment you do that, a PDF gets downloaded. The initial part is going to be exactly the same. The difference, what will be, is this page, wherein previously you could see this in percentage terms. Now, the capital that you've input, right, 50 lakh, that has gotten allocated in the manner of the percentages that are there in the portfolio allocation, right? So this is what the existing allocation looks like, and this is what on the right hand side is what the target allocation should be to achieve the excess return that we just discussed at the top. So this could practically be like an actionable proposal for your client. That was about it from my side for the topic related webinar discussion. If you have any questions, please feel free to type in the chat box or directly unmuting yourself to speak. Thank you.
Hi Prajakta, I have a question. Can I go ahead?
Yes, please tell me.
So, it's regarding the scores that you showed on the first screen, which was the risk score and the return score.
Yes.
Yeah, you click on the black box and it appears.
Correct.
Yeah. So what is the relation? How is it linked to the NGEN F score, FS score?
Okay, so let me tell you this. These are independent scores. So when you see a return score of 5.98 and a risk score of 4.23, these per se are not directly linked to NGEN FS, right? Because to arrive at risk score, we have just considered the volatility, right? Only volatility, which is a measure of risk. And that is how we have arrived at the risk score of it. On the other hand, the return score purely depends upon the returns that are generated by each of these funds, and that is how we've come up at to a return score, right? For an example, if you were to compare it with, let's say, some other funds, so I'll just simply load in HDFC large and mid cap in a new tab, and these can be compared like that. So I'm going to click on this. Now let's consider only return score for an example, right? So Bandhan's return score is a 5.98, a tad bit lower than 6. On the other hand, HDFC large and mid cap return score is a 6.6. Now, why is that so? That's because in a XYZ time period, HDFC generates a better return irrespective of whatever risk it has, right? As compared to Bandhan. So we can corroborate that, or we can cross verify that. So let me simply put in a time period of, let's say, 2 years, right? So in the last 2 years that I'm analyzing, the cumulative return for a HDFC is a 71%. On the other hand, I go back to Bandhan, I put in the same time period, let's say 2 years. I see typically this has, once again, this is, we should rather take this as a 5-year period. Let's take this 5 years. It's 173% for HDFC, Bandhan, 5 years, 157. Yeah, so you see the difference here. That's the reason Bandhan has scored a little less on the return score as compared to HDFC, because its return in the last 5 years is lesser than that of HDFC. But now let's come to the risk score of it. The risk score of Bandhan is a 4.23, which is slightly higher or better than HDFC's risk score, which is 4.04. Now, why is that so? Because the volatility of HDFC will be higher than that of Bandhan. So let's have a look. HDFC's volatility is 18% versus to that Bandhan's volatility is 18.03%. So lesser volatility, right? Therefore, lesser the volatility, higher will be the fund score. Higher will be the risk score. Now, these are the methodologies of calculating this risk score and return score independently. NGEN FS is totally a different thing. NGEN FS considers 10% weightage to AUM of these funds, and the balance 90% is coming from short, medium, and long term risk adjusted returns, meaning the Sharpe ratios is what we have considered to arrive at these, right? So it's not a weighted average of the return and the risk score. It is a different calculation that is going at the back.
Okay, got it. I have a follow-up question. For example, you can compare FS score for all funds on one page. Is there
Yes.
no tab that opens up wherein we can compare the risk score or return score? Do you have to individually open a fund to compare the score?
Yeah. As of now, yes. We have just, we have released, or rather, predominantly wherever you will see. So basically, in the fund section, the compare section, apparently, it will be only the fund score that will be visible. But of course, we will note this down as a feedback to incorporate risk score and return scores as well, right here, right somewhere. So then you can compare that as well.
Yeah,
So you
yeah.
can,
We would like to
yeah,
compare that as well.
sure.
Being
I will
that
note
it's
that down
not
as well.
related, so there's a point in comparing. Thank you.
Sure, understand. I will write this down as well.
Hello. Hi, Prajakta.
Yes,
Is this the in the first row NGEN 7.93 or NGEN FS code? Yeah.
yes. That will always be NGEN Fund Score.
And this is newly incorporated.
Yeah. So we released this in the month of November last year. So we're 3 months into it. Three and a half months.
Yeah, I missed the session because of my calls. Can you tell me when is the when again you're doing the same thing?
Sure. Yeah, we'll definitely cover this again. But what you can do is we will upload the recordings of this session on our YouTube channel. You can definitely refer to that recording. Additionally, we've also covered this, similar session wherein we have used Engine Fund Scores to build in model portfolios on 1st of December 2023 as well. So you can definitely go ahead and locate that video. I'll quickly show you how to do that. So there's a link to our YouTube channel right in the system. You click on it, it will take you to the YouTube page. We have a dedicated playlist that is made for webinars. Already 102 webinars uploaded. So you simply click on view full playlist. And I think this was 1st of December. Yeah, there you go. Building model portfolios using NGEN Fund Score. So this was covered 1st of December. You can definitely have a look at this recording. If you want to have the today's recording, this will also be uploaded in the next week.
Okay, thank you.
Thank you. Any more questions? Please let us know. Okay, looks like we do not have any more questions for today. So thank you so much everyone for joining in. I hope this session was useful. We'll be coming up with further sessions in the coming weeks as well. So do stay tuned. And as I just highlighted, you can definitely check out the webinar recordings from our YouTube channel. Thank
Hi,
you again for
Prajakta.
this.
I have a question.
Yes,
Sorry for the
yes,
late
yes.
reply.
No, no, not a problem. Please tell me.
Yeah, I just wanted to know, is there a way that we can check that the index which is there, right? Like Nifty 50 is there, which is the top like 5 or top 10 performing AMCs? Like, can we check that, like, which are the based on the index?
Based on the index, no, I mean, we have a tab, AMC tab, again,
Okay.
recently released. You go here in the funds section, and there is this AMC tab that's visible right here. You go here, and then let's say you want to find out in equity, as a asset class, meaning we are covering all the subcategories that are available in the equity as an asset class, right? So these are all the
Okay.
categories that we are covering across all AMCs, and then you simply sort this, let's say, on the basis of highest 1 year return, right?
Okay.
On the basis of, let's say, highest fund score, right? So that's possible to do.
Okay. So based on index, it's not possible, right? Just on index.
Based on index, I'm sorry, I do not understand your question quite clearly. So you're
Like,
saying that when you compare it with the benchmark, you want to know which all funds are the best performing funds.
yes,
How will
yes,
you do that on
yes,
the, but not on
yes,
AMC level then, right? Funds level.
yes. Yeah, fund level.
Ah,
Yes, yes,
that's
correct.
possible. That's possible. That's possible. So, for example, I am going to load in all the funds from, let's say, FlexiCap as a category. So, what I'll do is I'll turn everything off. I'll just choose FlexiCap. I'll click on close. I have put in some basic parameters. I'll just click on clear. So, I have all the 38 FlexiCap funds. I simply take them to
Okay.
the compare section in one single shot. So, right, so we have loaded in all the flexi cap funds. A relevant benchmark for all the flexi caps is Nifty 500, right? So once all of
Okay.
these funds get loaded, you add in Nifty 500 again as a row item. I'll show you how. 1 second.
Okay.
Okay, so we have all the 38 funds. You go here, add other items, and you add in the benchmark. So Nifty 500. You click on it, it gets added as a row item.
Okay.
And now you put in a time period. Let's say you want to do this analysis for the last 3 years. Funds performing the best as compared to the benchmark in the last 3 years. So you put that as a custom start date. So now what we are doing is we are analyzing the returns of the funds for the last 3 years, and then you simply sort this on the basis of cumulative return. So in
Okay.
this case, we see the benchmark is somewhere here. The benchmark return is 122%. What we have at the top is the funds outperforming the benchmark, right? So benchmark is right here.
Okay.
That's
Yes.
Nifty. And these are the
Yeah.
funds that have generated a better return than the benchmark itself. You could replicate that for any other ratio. For example, Sharpe ratio, right? You sort this on the basis of Sharpe ratio. You'll have a list of funds that have outperformed the benchmark when you compare Sharpe ratio as a parameter. So that's possible.
Okay. Okay. Yeah. Thank you so much.
No problem. Okay. Thank you everyone for joining in. Do stay tuned and have a great weekend ahead. Thank you.